Unclear. It's path dependent. If stocks down 40% and it happens, half a percent every week, for a year, they're not going to care. That, truth be told, they'll probably be happy about that. They'll have deflated this bubble without causing a systemic problem. It is systemic risk, the pipes of the financial system clogging up, that they're concerned about. So rates going higher and companies going bankrupt slowly, that's okay. Once again, they probably would like that. It would take the edge off inflation. If you got a massive drop where the system got clogged up and companies were firing in mass, so inflation, we had unemployment go from 3.5 to 6 in a month, then they're going to step on in. So it's really, once again, it's path dependent. The Fed wants to go deflate the bubble, reduce the balance sheet. They want to kill demand. They need to kill demand. I use the word need because killing demand means recession, okay, which is not good. When someone losing their job is just not a happy situation. But the only way to go stop inflation is to reduce demand or increase supply. The Fed can't increase supply, so therefore they got to go reduce demand, and they do that by raising prices. And so once again, if they can do it slowly, that's called your soft landing. Now I will say this, once again, to those naysayers out there, the Fed can create inflation easy. You just don't want to create it too quickly. And that's what they've been trying to do. They've now done this, but it's gotten away from them. They want to bring it back. Once again, they can go and get rid of inflation. Paul Volcker did that. But taking rates to 21% probably wipes out. That would not be pretty if that happened in today's world for so many reasons. The massive leverage we have now versus 40 years ago, chief among them. So the Fed's trying to go, land the jumbo jet on the aircraft carrier. It is possible. It's possible. It's not likely, but it's possible, and that's what they're trying to go and do. I think the more interesting question here is, what does Powell, call it the Fed, want? I would dial back to, we read certain things over thousands of years because they're right. We read the Greek tragedies, right? We still read them. At least some high schools do. We read Shakespeare, okay? Why do we still read these things? Because they focus on the great Achilles heel of humanity, ego, hubris. Hubris is always the destroyer of mankind. So once again, let's go look at, and our politicians clearly are overwhelmed with ego now as opposed to doing the right thing. I think that was down the middle, right? Didn't see either side. Hawks on both their houses.
Yeah, there we go.
Because they're both egomaniacs right now. Does Powell want to be remembered as Arthur Burns or as Paul Volcker? Arthur Burns, as some of you might recall, was the Fed chairman during Nixon. He wanted to raise rates when he saw the inflation coming. He wasn't allowed to because Nixon threatened to probably kill his family. And he didn't. And thus inflation got out of control and what we had in the 70s, among other problems with demographics. Volcker came in and said, I'm going to fix it. You're not going to like it, but I'm going to fix it. And he was no hero at the time. I can assure you that Reagan was not too happy with the recessions he was dealing with coming up with the 82 election. But who do we think of fondly now? Volcker is a folk hero. Arthur Burns is a name down the tank that no one even remembers. What do you think Powell wants to be known as come 10, 15, 20 years from now? I can assure you it ain't Arthur Burns. Now, is it Volcker? Maybe not that either. But if you put a gun to his head, he's going to tell you Volcker. And that's why I think that we should not think he can't go whole hog on this thing if he has to. He is not going to go down in history. The guy is worth X $100 million, had an incredible career. He is not going to tombstone say he let inflation out of the bottle, so we're like Venezuela. That's just not going to happen, man.
Harley, you've been outspoken that you view quantitative easing as money printing by itself, full stop. We're recording this Friday, June 3rd. Today would be the third day of quantitative tightening. So if quantitative easing is money printing, is quantitative tightening money destruction? And
money burning?
Depending on your answer on that, what do you think? What do you say?
Money burning.
Money burning. Yeah. So QT is money burning, what is going to be the effect of that on asset markets as well as volatility?
Well, just to be technical, QT has not started yet. It starts June 15th with the first pay downs, but that's a technicality. You're right. Today's the first, we're on day 3. Um, we have some chart somewhere which you'll pull up eventually, which shows basically the 4 main central banks growing their balance sheets by, 10, 20 trillion dollars, and the value of the civilized world stock markets and bond markets going up tick for tick. Is it a great correlation? It's spurious. No, I guess it could be in theory, but no, it's not. The Fed, going back to 08, 09, 10, the Fed wanted inflation. More importantly, they wanted to go get rid of debt. We had too much debt. The way you get rid of debt, away from massive growth, which we're not going to have, is you default or you inflate. And inflation is a slow motion default. So they want inflation to go burn off this debt relative to GDP. You get a 4 or 5% inflation rate, the debt doesn't move. You borrowed $100, you owe $100, but if GDP goes from 20 to 25 trillion, well then, your debt to GDP ratio goes down by 20%. That's a good deal. They tried to create inflation for wages. That didn't work. That's a different, longer story. But the money went somewhere. The Fed, central banks created inflation. It just was not in wages, so it wasn't in CPI. For God's sakes, man, look at assets, stocks, bonds, housing, jewels, art, all that stuff. It all went up. Now, which is, of course, a bad public policy, result, because the rich get richer. We widen the wealth gap, which is a disaster, of course. And so, was it intentional? No. They wanted to raise middle-class labor wages. That's what they wanted to do. They didn't get it. They got it now, because fiscal is stepping in finally. But, we had inflation. And if they really drain reserves, they really drain the balance sheet, I can't predict how, when, or whatever, but you're going to see it happen. The money's got to go get burned out someplace, and through the various pipes of the economy, you should see asset prices come down. Once again, when, how, where, I'm not going to go predict that. I'll just say at a macro 30,000 foot level, they printed money, and now they're burning money. That's it.
Assets on the balance sheet are treasuries as well as agency mortgage-backed securities. So they will be letting those roll off, not selling, but letting those roll off. $95 billion a month.
So far not selling.
So far not selling, yes. Yes, well, we'll get into that on the mortgage-backed securities. But first, Harley, I just want to give you credit on the treasury trade. You've structured a certain trade that you've made it public via Simplify, via one of your ETFs, and that trade is essentially, tell us it's essentially an option that's a put option on long duration treasuries. And long duration treasuries, as I said, historic routes going back to 1700s. So yeah, just tell us a little bit about that trade. Are you surprised how much you've been right? Do you think part of it was just you got lucky? And then we can just put up a chart of that ETF. It's been pretty good.
I'll always take better lucky than smart. Let's just begin with that. Here's what we knew. We knew that rates at 1%, 0%, negative rates in Europe on $18 trillion. That's the wrong price, man. Okay, let's knock it off. That's the wrong price. The only way you had negative rates in Europe is, one, the ECB put them there, but two is if you're a large pension fund, you can't go and take $1 billion in cash and put it under your pillow. You got to go put it somewhere for safekeeping. So in essence, negative rates was just the cost of security. Someone's storing the money somewhere. But that's of course ridiculous to have negative rates. We knew it was going to end. We just didn't know when. And it happened a lot later than we thought. What I did when I joined Simplify is we created the Simplify interest rate hedge. I can't give a ticker, and it was simply this. It was a half of a treasury, 5-year treasury, and half the money went to buy, effectively, a 7-year put option on the 30-year treasury. There's nothing else out there that does this. Okay, options on TLT or put options on TLT, they go out maybe 6 months. They're not that liquid. Over here, you could, basically buy options on millions of dollars. And that's because we source this option from the over-the-counter bank market. So OTC market. So we've basically faced directly with Goldman Sachs, Morgan Stanley, Merrill Lynch, and Barclays. We'll soon be adding a few more. And a gentleman's trade there is $100 million. I mean, let's remember, the bond market is much bigger than the stock market. Stocks get all the airplay. Jim Cramer talks about stocks. He doesn't talk about bonds, but we are much bigger than the stock market. And the size of money that flows through there is humongous versus stocks. You try buying $100 million of some equity, it's going. $100 million of bonds doesn't budge. And that's what we did. And by making a 7-year option, you had time, years, to be wrong. It just so happened that we brought the product a year ago, May, and the market finally moved. The product closed the year at 38. It got as high as 64. I think it's trading 54, 55 right now. It is a direct drive exposure to interest rates. If rates go back down again, this will go down, period. If rates go up, this will go up, period. It's direct drive exposure in a convex way. Because it's an option, it can go up by a lot, only down by a little or by less. And that's it. It's a clever idea. It's working well. And if you're curious, my advice is for every $1 million of interest rate risk, which can include owning bonds or bond fund, stocks that have long durations to them. If you are building a multifamily home and permanent financing is a couple of years away, you buy 5% of this product, this hedge for this. So if you have $1 million of risk, you buy $50,000 of the hedge, and that's how we size it. If you want to speculate, be my guest. But truth be told, this is a hedge product because it will be volatile. It has a lot of moving parts inside of it. It only has two trades, a treasury and an option. But that option is impacted by volatility, by the yield curve, by skews, by lots of different things. So it wiggles a bit.
Right, and it's a very complex product, so it's not like it trades every second. Also just say that if you own a 7-month put option on TLT, you constantly would have to roll that, whereas this is a 7-year option. I want to ask you, Harley, when I first heard you talking about this trade, I think the reason you were so attracted to it was that not just that you thought the yields were going to go up, bond prices would go down, the delta, but you thought that the implied volatility was much too cheap. How much of the profit of this trade has been just rates have gone up and it's delta has been in your favor? And to what degree have you actually had sort of vega move in your favor where the market has implied volatility has spiked as people are saying, hey, rates are moving higher. Maybe we should price this option a little bit higher in terms of vol.
Vols have been volatile. When this trade came out, I think you're going to show a chart. That chart is the at the money option. That's really the only access you have to this thing is to chart that number. This option was initially 200 basis points out of the money, and it has since, as rates have gone up, it's come closer. So the skew rolls on down. When we brought this thing, the vol you paid for the option was about 74.75, with the at the money being like 64.65, so about 10-point spread there. The vol got as high as 86 on this option. It's now backed off to about 77, 78. So, and that's probably worth about 5 points. So this thing probably went 5 points too high, but it's since come back to the level where it was. So it's a much better trade now. The offset to this was the yield curve inversion. And I wrote about this on my commentary a few months ago. If you go to convexitymaven.com, I have all my stuff there. If you want to join I publish every 4 to 6 weeks. Just send me an email. I'll add you to my list. So the one called Fire Insurance Revisited, I go in detail through each separate component of the funding cost, the yield curve, volatility, rate level, the whole thing, and I deconstruct the whole trade. But this ticket, I push back on calling it complicated. You could model this on Bloomberg or on an Excel spreadsheet. I mean, all you need is two interest rates and a volatility, and that's it. And the modeling I do in my various commentaries is I just fix vol at a number, whatever it is at the time, and move the curve in parallel. Is that fair? No, not at all. The curve will not be moving parallel. But I got no plan B. I mean, I got to assume something, and I think moving it in parallel is as fair as you can get. To start to imply curve movement is really speculative. I can assure you that versus a year ago and now, nobody thought the curve was going to flatten and invert at 275. Like, I mean, maybe Rosie and Lacey did, but no one else on the planet did. So to go and start projecting yield curve movements is a step too far even for me.